Welcome back. You're watching Business Morning. We're talking about the state of the banks now. And at the just concluded Monetary Policy Committee meeting in the nation's capital, Abuja, the Central Bank of Nigeria pointed out that the banking sector was becoming less resilient as a result of the adverse macroeconomic environment. Nevertheless, the MPC reiterated its resolve to continue to pursue financial system stability. And so to this end, the committee enjoined the management of the bank to work with deposit money banks to promptly address rising non-performing loans, declining asset quality, credit concentration, and high foreign exchange exposures. And that was also further corroborated by a recent report from international ratings firm Fitch, which also said that Nigerian banks will continue to face challenges this year following an extremely difficult 2016. So, have banks thought of innovative ways to deal with the macroeconomic uncertainties? How can the Central Bank of Nigeria, what role can the Central Bank of Nigeria play to help to cover this gap? Because notice that most of this NPLs has caused the risk exposure for the banks to rise astronomically above the 5% threshold as accorded by the Central Bank of Nigeria. Let's talk to Oji Udemezwe, who is a chartered banker and is also a financial management consultant, CEO, Flame Academy and Consulting Limited. It's great to have you on the program.
Good morning, Harriet. It's always my pleasure to be here.
So, the committee has specifically expressed concern. That's the Monetary Policy Committee now coming in from Tuesday's meeting. It was a situation where a lot of market watchers were hoping that something might happen to tilt it in favor of the banks, even though they weren't expecting to see so much change on any of the key rates. But the banks.
The central bank decision at any point in time is not particularly meant to be tilted towards any particular sector. It is just meant to improve the economy. Because when the economy gets better, every sector gets better. But let's put this on perspective. The life of any economy is strongly, intertwined with the banking system. No economy can progress or can get healthy without the progress and the health of the financial sector, also being there. So you find that, when you have a problem in the financial sector, it gives rise to a problem in the economy. And vice versa. When you have economic challenges too, they give rise. So the economy cannot thrive without the financial sector thriving. The two are together. That's why I want to see any economic crisis, it always ends up with financial crisis. And if you see any financial crisis like the type we had, 2008, 2009, it also always ends up with economic crisis. And many parts of the world are still struggling out of that crisis till today, 10 years after almost. So the financial sector is so critical to the growth and development of any economy.
But then, Mr. Mbe, sorry to cut you there. Some people have actually said that for most of these banks, particularly in our own atmosphere, that they are largely responsible for what has happened. We're talking about high FX exposures. We're talking about non-performing loans. You're talking about declining asset quality.
We're going to get to all those issues, that give rise to this. I don't want to start, pointing accusing fingers. Nigerian banks, truly and fairly, are the model of banking in Africa, as it were. I've gone around the world. I've trained banks around Africa. I just came back from somewhere around the world, to train. I've studied several banking systems around Africa.
And you're a former banker yourself.
I'm also a former banker. So many other African banking systems, from Ghana to anywhere around the world, they try to model even their, supervisory approaches, after the Central Bank of Nigeria. So we are getting a lot of things right here. But there are a lot of also, a lot of human factors that are also militating against the health of our banks. So if you want us to go into it directly, then we can begin to deal with the issues. But I would just want to say that banks are only suffering from what's happening in the economy today. Because banks only play a role in the economy whereby they channel the available resources, any idle fund, or the funds they can get from the surplus sector, to channel to the deficit sector to grow the economy. And in the economy, like economists will tell you, investment is always equal to savings. So what banks do are critical to the economic growth. And then banks don't operate in a vacuum. They operate within an economy. And when the economy is not doing well, who are the players in the banking sector? People who also run businesses in the oil and gas, in manufacturing, in agriculture, in public sector, every part of the economy. If there's high unemployment, economy is shrinking, things are not working, most likely bank customers will not be doing well. Those who give deposit will give less deposit. Those who have taken loans from banks will be largely unable to repay their loans. So you see banks, dealing with a huge, issue of credit quality. But the problem where I see the CBN concern is that we are, as at last year, December, we had about 18 trillion, roughly 18.5 trillion in total loan portfolio to private sector of the economy. Out of which about 1.85 trillion, has also gone bad. But my worry, which is also central bank's worry, is that out of that 1.85 trillion that has gone bad, nearly 40% or more are linked to director-related lendings. That is, people who run these banks, directors or chairmen, or whether independent or non-independent directors, or people who are connected with directors one way or the other. And in the C's of credit, even though we deal with 5 C's of credit, some other C's that people have come up with, it has to do with connections. People that borrow from banks, what are their connections with the bank, and how can these connections affect positively or negatively their willingness and ability to pay back their debt. So that's where I see a concern. If we have 40% or more of bad debt in this economy today linked to directors, something has to be done about corporate governance. That's where their issue
That's
is.
why I said earlier that banks are still largely responsible for what is happening. Even though we've got macroeconomic uncertainty, they also had a hand.
There's a conflagration of these issues that are causing this problem.
Even if this, with regards to the issue of corporate governance now, if this directors, either non-directors or directors, had taken these loans and given it to fundable sectors, not the oil and gas, because largely we had major issues with oil and gas, non-performing loans, and also from the power sector as well. So why not give it to that critical sector of the economy, agriculture, manufacturing, where you know that you can get returns almost immediately?
These are issues that have continued to bedevil us. The sectors where we should be lending to, agriculture, manufacturing, and so on, these deposit money banks don't find them all that attractive because of the